What's good, guys? Welcome to this section, and we'll be discussing the entry model. Before we dive deeper into the concepts behind our entry model, I want to show you what we'll be looking at when we get to the market. The format that I'm basically using here is for the sell side. So once you understand that we are going bearish for the day, this is the model that we want you to use in taking your trades. It's very, very simple. Remember, I don't want to complicate things for you. I just want the pattern and the strategy to just be simple for you to just grab. And for that reason, I had to just bring out the pattern, just write down the necessary things, and yet still create a plan for you, create a training plan for you. With time, you might always dive deeper to studying other factors about ICT concepts. But for now, for the sake of profitability and as students, yeah, one of the main reasons that attracted you to the mentorship is to learn what works and start using it to make money in the market regardless. So this is what I'll be able to do for you in this course. But after this, I will want you to go back and watch the concepts better for yourself, understand this concept, and then use it to advance your knowledge. Remember, I told you in the psychology classes that a forex trader is a scholar, so you need to equip yourself more. You need to learn more. You need to understand this concept in depth. You understand me? So I'll try my best I'm going to try all I can to lay it out for you, in such a way that when you get into the market, it's going to be very, very clear for you. So what we'll be having here is the entry model. The entry model is just basically what you call your pattern, what you want to see, the storyline, what you want to see play out after you might have understood your bias for the day. Remember, I told you the most important thing here is for you to know the bias for today. Are we buying or are we selling? So once you understand that you're buying or selling, this is what you will now use to go make money from the market. Now, the logic behind our pattern. Now, as you can see here, this is the pattern I want you to see. Now, this is the whole logic here. So I'm going to explain this. Obviously, there are different types of concept that you might have come across, and it's the same thing. But remember what I told you: in every trade that you take, there is always a logic behind the pattern. And what makes ours very different is because of the logic behind the pattern. We don't just trade the pattern for a pattern's sake. You understand me? We trade it with logic. So the logic behind this gives the trade a higher chance of winning, a high probability. This is what we call a plus trade. When you have an A plus trade in the market, a higher probability trade in the market, you are okay and you are good to go. Now, this is an A plus trade that I'll be showing you on how you could go about it. Now, this pattern forms at least every day, but it doesn't form every day in the same way. Let's say, for instance, AUD USD. You won't see this pattern on AUD USD on Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, like Friday. You won't see it. You won't see it Monday, Tuesday, Wednesday, Thursday, Friday. You ain't going to see that. But during the week, Monday, Tuesday, Wednesday, Thursday, Friday, one of those days, you will have this pattern form in AUD USD. You understand me? 1 or 2 days, you might see this pattern form in that pair. Now, this pattern forms every day. What do I mean by that? It only forms every day across different USD pairs in the market. Basically, what we are focused on in the Celebrity Traders Club is trades that are being paired with USD. You understand? As USD is the most traded currency pair in the world. Why I love this logic is because once you focus on one currency pair like the USD, you will be so focused on their news, understanding their news, their economy. All your stocks will just be on the USD. Once you have the grasp of what USD is doing at the moment, it has a higher probability of changing the market regardless of the pair that is being paired to, because it's the dominant pair in the forex market. You understand? So that is it. So this pattern forms every day in the market, every week, every month. You see this pattern play out in the market. We need to consider ourselves as a hunter of self. Now, the hunter doesn't just walk into the forex and start shooting. You understand? He has a certain plan and track he uses every day when he goes out to hunt. he has his plan and he knows the track that animals do comes in and all those stuff. As a hunter of setups, you have your plan, and this is our plan. As a hunter of trades, we have our own logic and our own plan, what we use in having the kill shot in the market. Understand? So prior to our hunting day, we set traps that's going to help us catch the prey effortlessly. You understand? And we also have a particular track that we stay to wait for our target. A hunter goes into the bush, he doesn't just walk around. He goes up to his track, stays still, wait for the animal to come, and then he shoots. This is what we do in the Celebrity Traders Club with this pattern that you're seeing here on the screen. We don't just rush in and start shooting. We wait quietly, patiently in our track. And the appropriate time, the trade setup is going to play out itself. Remember, I told you that time is a crucial aspect in the market. So this is what I'm showing you. This is the premium information that you have been looking for. Understanding the time factor here in the forex market gives you more navigation, helps you stay patient on your chart as a hunter and wait for a setup to fall in between those periods. Once we spot our target, we take the shot. Now, when we take the shot, two things happen. When a hunter takes the shot, two things happen. He either kills the target or he misses the target. Now, regardless of the result for the day, the hunter comes back again, repeats the same process over and over again, irrespective of the result of the previous day. Now, remember, I told you something on the psychological classes about understanding your edge and thinking in perspective of trade series, not a single trade. So, irrespective of what happened today, we are still going to come back the next day, shoot the same pattern, the same process. We take the same trade, we shoot and we shoot and we shoot. Now, the result of the day doesn't bother us because we don't know what we are going to expect. But the main factor here, what I want you to really understand is using this same factor. The exact thing that you're seeing here is what you will be using to take your trades without deviating from them. Go into your chart, backtest this thing, understand this very, very well for yourself. Now, I will teach you this thing and you're going to know it very well, but backtesting gives you more confidence. As a trader, you need that personal confidence. Now, going into the chart to see this thing plays out gives you more confidence because you've heard it from me, and now we now go into the chart and you see it play out. Using these patterns, you need to understand that there are seasons where the hunter goes to his track, goes to the charts at the exact hunting time, but the prey doesn't show up. He goes in again the next day. Same thing happened. The prey doesn't show up. Two things are going to happen here. You understand me? You continue sticking around waiting for your setup. Now, if you are trading one pair, you might be faced with this option here. Going into the chart and you don't see a setup for the week. When you go across different currency pairs, you are going to see this thing play out. Now, I don't advise you to go and start looking at 10 currency pairs at the same time. You will divide your focus. If you are not a focus trader, like a full-time trader, when I mean a full-time trader, you don't have anything disturbing you. Your trading desk is set up. Your trading screen is set up. No disturbance. You're in your room alone. You're in the zone. And you have all the time to yourself during this particular time. It's like you're going to resuming your job at some point. You don't have any engagement during this particular time. The only engagement you have is forex trading. Now you can actually load up 10 pairs. You can actually, because I think there are only like 10 pairs paired to the USD, major pairs paired to the USD. There are 10 of them. You can load them out just before your time. You just check them out. You understand? You scan like a hunter, you check them out. But if you are not really focused, I'll advise you just go with 3 currency pairs. 3 is the maximum you can go with. As far as I'm concerned, if you're a student and you're schooling, you're still with your parents, you are not really focused, you don't really have the time to manage these trades and look at random pairs because it can be very tedious to manage all these trades. Do you understand? So you might go into your chart and you don't see this pattern play out. You need to understand that it happens. There are seasons where these things happen. There are seasons you're not going to see. Like the month of June, July, August is basically considered a very worst time to trade the forex market. So these are like sessions and seasons that you will expect less of your analysis to play out. Do you understand? You need to understand, you need to know these seasons, you need to know these times where your analysis plays out perfectly. Let's dive deeper into the logic behind this pattern. Now, as you can see here, I told you earlier on that the strategy is being built on liquidity. Now, what we are seeing on this pattern is we have analyzed everything for the day, and we know that the day is going bearish, that the candlestick is likely to expand lower, going down. Now, coming into our chart, we have different time sessions. We have different time zones. Like London session, we have the New York session, and we have Asian session. We have all those sessions. But the most important session is the New York session. Remember, your job as a trader is to make sure you cut out noise, cut down things, and create your own pattern. So we understand that the day we are going to close bearish on the day. So when we come into our chart, before the New York session, we are going to go lower to our entry time frame, which is the 15 minutes. We are going to go lower to our entry time frame, which is the 15 minutes. Now, once we go lower to our entry time frame, which is the 15 minutes, we mark out the highs and the lows. We mark out the buy side and the sell side. Yeah, you're seeing. Now, this is what I mean. Before New York session, you want to be marking out these highs. You want to be marking out these highs before this New York session. You want to mark it out, mark the low, mark the high. Now, since we understand that we are supposed to be selling in the market, now as smart money traders, if you understand that you're supposed to be selling, what you wait for, because this game is a game of liquidity, taking people out, is a game where the market makers want to take people out before going in the desired direction. So since we are selling, what do you think is going to happen? Before the main sell in the market happens, there will be a buy side manipulation in the market. So what do we want to see? We want to see the highs that we marked out before 8 a.m. Before 8 a.m. New York time. Before 8 a.m. New York time. Do you understand? Wherever you are in the world, you need to convert this to your own time. But it's advisable that when you are trading on the trading view chart, change your time frame to the New York time. That is the UTC -4. If you don't change it, all what I'll be showing you on this mentorship, you won't get to understand it. Now, before 8 a.m., you want to see a run on buy side liquidity. You want to see this run on this buy side liquidity. So what will be resting here is their stop losses. Their stop losses is basically the buy side liquidity, and that's what we want to take out in the market before selling. So we had traders that were selling here before, early sellers. So since we understand that the market is selling today and it's now closer to our time frame, our Q zone, when we want to take our trades, when we want to see our pattern play out, when we want to see the storyline play out. This is me building up the storyline for you. What is the first storyline? Mark out the buy side liquidity, mark out the sell side liquidity, mark out the liquidity resting above here before this time. Now wait for that liquidity to be run inside this time frame, this New York morning session from 8 a.m. to 10 a.m. Once you see that happen, you want to see price come back into that range and then break structure. You want to see market rally down with a huge volume displacement. Call this displacement. You want to see a huge volume coming in. You don't want to see after this break, after this grab of liquidity. You don't want to see little ticks. You don't want to know. You want to see it drop huge and create a huge candlestick, leaves behind a huge candlestick. Do you understand? Once the break happens, you want to see price come back into a fair value gap here, an imbalance that price left here because of this huge displacement that it had done. Don't worry, I'm going to explain this in details, but understand this. Now, this huge volume here, you want to see a space, an imbalance here, where price could trade back into, then this is where you want to take your Q shot. This is where you want to be selling. Now, notice this thing is happening inside this time frame, this time zone. All these things happening. Now, what happens? You ask me, City, what happens when I don't see this thing happen? What if this thing is not forming here and you don't see it happen? Then you don't have a trade for that day. You leave your chart and you don't force a trade. You should have confidence that if you don't see it today, you're going to see it tomorrow. Do you understand? So that is the That is the sexiest thing that could happen to you as a trader, understanding that your pattern is going to form again tomorrow at the same time. So if you come today and it's not there, what do? You leave. You leave the market. If you go to a supermarket to go buy something and you go there, you don't see what you are looking for. Would you start picking things that you don't need? You don't pick. If you went there to buy something, you will start. If you don't see that thing, what you do is you will leave that place. It's either you go look for another supermarket to look for what you are looking for, or you go back to your house and come back the next day, because it's always going to be there the next day. The next week you are going to see it. So the first thing here is the buy side liquidity. That's number one. That's the first thing that happens in our story. A buy side liquidity being run. The first thing that if you are selling, the first thing if you want to sell for that day, the first thing we want to see happen in our storyline is the buy side liquidity being run. Once that happens, the second thing we want to see a huge candlestick drop, a huge displacement with huge volume. That's the second thing. The third thing, you want to see that huge candlestick break market structure. If it doesn't break market structure, it's not valid. Look at this one now. This is buy side liquidity, right? But market came, broke that buy side liquidity, ran through that buy side liquidity, grabbing all those liquidity. But it came back down. Did it break market structure? No. So you don't have a trade. You wait. You wait to see a break of market structure. It came back once more, grabbed liquidity that was resting in buy side liquidity inside our time zone. Grabbed, then did what? Came back down with huge displacement and then broke market structure. Now, once you see this happen, you see these three things happen. One, buy side liquidity run. Two, displacement. Three, breaking market structure. You now understand that your pattern is now forming. Your pattern is now forming. You wait. You wait to see it form everything. Now, the third thing is breaking market structure. The fourth thing we want to see is price come back inside and tap into an imbalance. That's the fourth thing. That's a fair value gap is also called an imbalance. Then that is where you want to take your trade. After you see that happen, now that is when you want to take your trade. Remember, I told you this chart is being built on logic here. So let's go inside and see what other logic makes this trade a high probability trade for you. Number one, there is a buy side liquidity that has been run. Buy side liquidity run. Don't always forget that. If you are selling, you want to see buy side liquidity being taken out. If you are buying, you want to see sell side liquidity being taken out. Now, after that, you see a break of market structure. After that, you see displacement. There is break of market structure. That's displacement volume. After that, the displacement candle, here is another thing. The displacement candle should always leave behind a fair value gap, an imbalance here. I will teach you what an imbalance is. But you should know that the displacement should always leave behind a fair value gap. If you don't see a fair value gap, guess what? You don't have a trade. Irrespective of all these things that has happened, even if you have seen all these things happening, if it comes here and you don't have a fair value gap and imbalance here, where are you going to take your trade from? Obviously, you don't have anywhere you're going to place your trade from. You don't place your trade. So once you see a fair value gap and imbalance, you take your trade here and your SL is above structure, and then you target the sell side liquidity. After buy side liquidity has been run, get this is another concept, a very important thing you need to have at the back of your head. You need to register into your subconscious. After you see buy side liquidity being run, what you want to see price do is you want to see sell side liquidity being taken out. This is a major sell side liquidity from the higher time frame, let's say H1. So you want to see price run back into that sell side liquidity. Why is this happening? The market makers, they saw price here. They are selling. Where will be an ideal place for them to sell their price, to go out of their position? Where is going to be an ideal place for them to go out of their position? Obviously, here, because there are a lot of sell side liquidity resting here. The sell side liquidity is as a result of people buying the market. These are buyers here. These are buyers resting on the sell side liquidities. So the market makers, they are selling. What do they want to do? They want to sell to people that are buying. In the market, There must be a buyer and there must be a seller. So since the market makers are the seller here, who would they be selling to? Obviously, they'll be selling to people buying here. The double bottom guys here that will be buying here. Obviously, that is what we call the sell side liquidity. So that is where they are going to target to take out all their position. And that is where you should target to as a smart money trader. I'm going to dive this deeper into these details when we get to the liquidity lesson. Now, PDRA, premium and discount pricing. Let me just brush through. As a smart money trader, you want to be buying at discount and you want to be selling at premium. Now, how do we know a premium and discount price? You take out your fee and measure the swing high starting from this place here, this displacement here, to your swing low. And then once the market has started retracing, you measure that. Now, above the 50% Fibonacci level is what we call premium price. So what you want to see, a high probability setup, is you want to see your imbalance form inside above the 0.5 Fibonacci level. That is a premium price. I'm going to dive into the concept behind premium pricing on the PDRA lectures. Now, sell side liquidity attack. This is what I'm saying. After the buy side liquidity has been attacked, what you expect is the sell side liquidity to be attacked. Now, Judas swing. You might have noticed this line that I marked here. The straight line that I marked it, I said New York midnight open. Now, Judas swing is basically another pattern of manipulation. A higher pattern of manipulation is called the power three. The accumulation, manipulation, and distribution. I'm going to dive deeper into this in the section. But you need to understand the concept behind this. The concept behind this New York midnight open is prior to New York open, remember this is 8 a.m. Now, New York open will be, New York midnight open is going to be 0.00 on your chart. This time here that you're seeing, it's going to be 0.00. So you want to mark that out and you want to note the candlestick that opened. So this is where we opened for the day. This is where we opened for the day. Do you understand me? So you mark that out. This is the first candle that formed prior to that time. So marking that out, you understood that price rallied above that. So what you want your Judas swing to do, you want to see it go higher. You want to see price go higher before coming lower. I repeat that again. Judas swing when you're selling is simply you price going higher above the opening price before dropping down. You don't just want to see the day open and then price start dropping. No, there must be a certain point of manipulation. Price will go higher before coming lower. There is always an Asian range that is here. The Asian session normally has a kind of consolidation here. You understand? Price just ranges here. Now, what you want to see, since they are selling, what you want to see price rally up, take out those liquidity. This was the accumulation during the Asian session. Manipulation, run up, then distribution. So this is what is happening. The accumulation had been here before this day. Then this is the manipulation. This price up here is the manipulation. And now this is the distribution. Now what you want to be doing, why this helps you in having a high probability trade is, if you are selling, you want to be selling above the New York midnight open. You want to sell above that when the market is currently in a manipulation phase. You want to sell above that price, the New York midnight open. Go into your chart and understand this concept that I'm teaching you. You'll be blown away at how price delivers exactly to what you're seeing here. And also, the most important thing is time. All this thing is happening during this time of the day, 8 to 10. This is it. 8 to 10 New York open. UTC -4. Change your chart, UTC -4. This is when this pattern plays out. So understanding this is your entry pattern. Now once you watch, after you might have watched, because I don't want you to watch this and just jump into your chart and start taking trades, or you think you will understand it. No, you're not going to understand it. I'm just showing you here for you to just see what you'll be taking and what you'll be expecting, so that once I'm explaining the concept, you will be able to relate it very well with what you've seen here. Do you understand? So that is all for our entry model. We'll be diving deep into the next We'll be diving deep into the concept. We use the smart money concept proper. The smart money concept that we'll be diving into is basically liquidity. We'll dive into imbalances, that's fair value now. We dive into break of market structure. What a break of market structure, what qualifies a break of market structure. Now we'll be also diving into time proper, explaining the logic behind time. We'll also dive into the Judas swing, that's the power three. You understand? Then we dive into PDRA, that's the only thing you need to succeed as a forex trader. This is just the 20% of technical analysis that you need to understand. The work there is going to be on psychology. This is just an edge in the market that will help build your psychology. So catch you guys later on the next concept.